Hello, and welcome to the Global View on this Monday. I'm Andrew Gagan. Thanks for joining us again here at AusBiz as we get across what is going on globally. Let's begin with what we saw on Friday. And equity markets falling, oil prices rising with no end in sight to the war in the Middle East that is fueling inflation and sapping consumer and business confidence. US stocks tumbled with the three major Wall Street indices closing at their lowest level in more than 7 months, while the Dow joined the Nasdaq in correction territory, having fallen more than 10% from its record high. The indices suffered their fifth straight weekly decline, the longest such streak in nearly 4 years. And the CBOE Volatility Index, or Fear Index, at its highest level since last April's Liberation Day tariff announcement. The software shares came under renewed selling pressure, while the mega caps were the biggest drag, with Nvidia falling along with Amazon. And the consumer discretionary sector was the worst performing. Cruise operator Carnival slumping after cutting its annual adjusted profit forecast. Norwegian also sinking. Well, as the Middle East conflict enters its second month, the war is widening. Yemen's Iran-aligned Houthis joined the conflict on the weekend, attacking Israel and raising the prospect they could block a second key shipping route, the Bab al-Mandeb Strait, an entrance to the Red Sea. Israel has launched more than 140 airstrikes on Iran over the past 24 hours, hitting ballistic missile launch sites and storage facilities. And the Pentagon is reportedly preparing for weeks of ground operations in Iran with the deployment of US troops. Meanwhile, Pakistan has said it's preparing to host meaningful talks to end the conflict, although Iran has accused the US of preparing a land assault while seeking negotiations. Iran's parliament speaker, Mohammad Khalibaf, saying, "As long as the Americans seek Iran's surrender, our response is that we will never accept humiliation." Well, US consumer sentiment has fallen to a 3-month low as the war boosted oil prices and unleashed volatility on financial markets, with expectations for inflation over the next year jumping to 3.8%. US Treasury yields rose on Friday as geopolitical and economic uncertainty persisted. The 10-year yield was at 4.44%, the 2-year at 3.91%. Australian 3-year government bond yields were at 4.85%, the 10-year rising to 5.17%. US dollar index closed higher, on track for its strongest monthly gain in almost a year, buoyed by safe haven demand. The Aussie has fallen back to 68.5 US cents. Well, oil prices could surge well beyond current levels as the Iran war unfolds. That's according to analysts polled by Reuters. Brent futures have surged by more than 50% since the war began, and prices are expected to remain high under different scenarios, according to the poll, potentially climbing to $200 a barrel if Iranian export facilities are damaged. Brent crude futures rose to close close to $113 US a barrel. That's the highest since 2022. Gold surged more than 3% on Friday on dip buying. Spot gold currently at around $4,490 an ounce. Copper rose marginally. Iron ore is at 110 US a ton, and Bitcoin has fallen back to $65,000 US. Well, let's get across what is going on in global markets at the moment. Matthew Goodson is joining us from Salt Funds in Auckland. Matthew, welcome back. And uncertainty remains, and in particular for markets, it's trying to work out when this conflict may find an end. That seems to be impossible at this point.
No, that's exactly the case. We have US futures down another 60 or 70 points at the moment. And the hard thing for investors is to figure out what's posturing ahead of negotiations and what's going to happen for real. So, for example, we know the entry of the Houthis, the shipping of some US ground troops to the region. Is that simply to strengthen a future negotiating position? Or are these events that are going to play out on the ground? And I think the key risk to markets here is duration. I think your comments earlier hit the nail on the head. If the duration continues, that's when you start seeing very sharp rises in oil prices further from here, which could be the key issue.
And of course, how that feeds into economic growth, what sort of a break that's going to put on that, particularly given those oil prices rising rapidly. Matthew, at what point are we going to start to see this factored into earnings growth forecasts?
We're starting to see it in some of the economic indicators now. So on both sides of the Tasman, ANZ-Roy Morgan consumer confidence numbers out on Friday showed a very sharp decline. Now that can obviously bounce back again quickly if this ends, but that will be quickly feeding into what companies are experiencing on the ground. So, certainly, I think June half numbers are going to have to come back quite broadly. And as well as that, obviously, we've seen higher bond yields. They've proven no safe haven, and that will affect companies below the EBIT line as well.
Yeah, and this is the issue that central banks are grappling with at the moment, that dilemma, obviously, with rising inflation, but at the same time, stagnant growth. I mean, it does give rise to stagflationary conditions. So how do they handle that?
Well, to date, and certainly in New Zealand, we've seen our governor say, she's willing to look through it in the short term. And it's something really, it's the central bank's worst nightmare, and that it's, the only way to lower inflationary pressure is to beat down on already weak demand in an economy that has significant excess capacity. So I think it's one of the interesting things between Australia and New Zealand at the moment is the Australian economy has been running pretty hot, hence 2 recent rate hikes, whereas we've been on quite a sharp easing path, and we still do have an awful lot of spare capacity in this economy. So perhaps just a little more scope for the Reserve Bank of New Zealand to sit on its hands for now.
So, Matthew, the question for investors is, how do you position right now? Particularly, I guess, if you're a longer term investor, do you try and ride this out, or do you need to be altering your portfolio in your view?
That's a great question. The way we've approached it is pretty much $1 each way. It's very hard to know if this will be temporary or if this will be of significant duration, and I think it would be foolhardy to make a major bet on either one of those scenarios. So, look, we're trying to do what I think most investors should be doing, which is buy good companies at attractive valuations. And, we're certainly seeing some of those pop up at the moment. And as long-term investors, you have to look through, if there's going to be a weak quarter or a weak half, well, so be it. If that's been capitalised out for many years in the future, there could be some good opportunities pop up.
All right. What can you give us some clues to what you're looking at the moment? You talk about good companies, attractive valuations. Where are you seeing that at the moment?
Look, we've seen what's happened in the market is stocks you would think would be safe havens haven't proven to be. The selling's been fairly broad-based. So there's no one sector or one name I really want to share that stand out. But because the selling has been quite broad-based, it's certainly created a few opportunities in our view across sectors where, we have good solid companies who earn strong returns on the invested capital and may suffer temporary interruptions to that. That's what we're looking out for.
On a sector basis then, Matthew, there are those that perhaps you're looking for those opportunities and others where you're avoiding them at the moment?
Yeah, I don't think it's a time to pile into expensive safe havens. You're either in cash or you're investing in companies which are trading at a good discount to any reasonable assessment of fair value. So that's probably the one area we're not is a number of there's a few obvious safe haven sectors which have held up pretty well. And that's perhaps where we look to just harvest some gains and reinvest into other sectors that have been struggling.
And Matthew, on your side there, any particular company news you're getting across at the moment?
Oh, look, it's been pretty quiet after results season. We've just seen several of the retailers come out. Turner's had a very well-regarded investor day last week, suggesting significant growth potential to take them well above their current 9% share of the New Zealand used car market. Had the Warehouse, which is really struggling, has been for years. They have a massive sales base and footprint around the country, but their gross margin is incredibly close to their cost of doing business, which doesn't leave a lot left over. So new management is attempting to do the right thing and really trying to drive costs down. But one hopes that it can be turned around. It's such an iconic New Zealand name, but it's going to be a long, hard road. And Kathmandu has gone into trading suspense as they are trying to raise equity, and just what the outcome for that is just looks a little uncertain at the moment. So that's one to very much keep an eye on.
Matthew, great to get across what you are seeing in markets at the moment. Thanks for joining us from Salt Funds.
Pleasure.
All right, that is the global perspective. Let's just, before we get across the open, take a look at where SPI futures are at the moment. No surprise, they're down 0.75%, reflecting certainly more selling on global markets on Friday as the markets react to that news flow out of the Middle East. Join us for the open in just a couple of minutes.